Hello and welcome to Dialogue. A hopeful Chinese economic outlook at the beginning of this year has met with COVID-19 flare-ups and uncertainties arising from the Russia-Ukraine conflict. So with the numbers in, how did the Chinese economy perform in the first quarter of 2022 at a growth rate of 4.8%? What are the main economic challenges China is facing, and how will the country respond? To discuss these issues and more, I'm happy to be joined by Professor Liu Baochen from the University of International Business and Economics, and Michela Geraci, former Undersecretary of State of the Italian Ministry of Economic Development, and Charles Liu, founder of Hall Capital and Senior Fellow at the Taihe Institute. That's our topic. I'm Xu Qinduo. So Charles, I'll start with you. Okay, we have the numbers in now, 4.8% for the first quarter economic growth. What do you make of this number?
It's slightly above expectation, actually, because there were a number of factors which impacted on the first quarter, especially the COVID-19 breakout in a number of places. But fortunately or unfortunately, the breakout in Shanghai, which is the most serious impacting factor, actually was the end of March. So the real impact on the economy is not yet seen. The impact of Shenzhen, for example, was resolved rather quickly. So I think, first quarter is always Chinese New Year time, which means there's a lot of consumption. So 4.8 is not bad, but it's going to be difficult to maintain that level going into the future.
Mm-hmm. Michela, obviously 4.8% is a number. If you compare that to the last quarter of last year, that's 4%. So much better than you see a pickup in the speed of economic growth. And then, of course, the overall, the yearly target is 5.5%. So far from that.
Well, if you remember previously, we discussed that in a way the Chinese government always meets its target. And even in this quarter, we have numbers that exceed the expectation by a little bit. So that's an encouraging sign, not just because it's 4.8, but because it shows a little bit the resilience that Chinese economic system has when there are problems. And it seems that the relatively minor problem that we had for lockdown in Shenzhen, the Ukrainian war, of course, small in terms of economic impact on China, have been dealt with. But I agree that the problem will be in the second quarter when we see the full effect of the Shanghai lockdown that started really in the last part of March. And so almost not captured in the figures of the first quarter. Let's remember, it's not just Shanghai. There is a series of cities that continue to be in lockdown in a kind of a sequence, one after the other one. We also worry here in Europe. Just this morning, I was discussing with colleagues about the implication on the supply chain. What happens if the Shanghai port faces some difficulties in shipment that we already had last year? And so I'm more worried that things may get weaker in the second quarter. But then again, if we look at the 5.5 that you asked about the full year, that all depends on when Shanghai will open up again and when the measures of zero COVID can be readjusted, maybe mitigated in its, let's say, strength that has hit Shanghai very much. And maybe the learning from the Shanghai experience could be used not to repeat similar let's say mistakes or error or underestimate, because I understand, I was in Shanghai, we were all caught by surprise by the increase in cases suddenly. But so I think Shanghai is paying a price, and this price can be put to the service of other cities should the problem happen for the following few months. Hopefully not, but it's it's an experience that can be reused for good.
Mm-hmm. Baochen, obviously, break down for us, what are the sectors we see strong growth? That's, generally people would say, first quarter is quite normal, without much impact from the restrictions to deal with the COVID, probably also not much impact from the Ukraine war, let's say. So, and also this is a festival, a spring festival at the time too.
Well, globally, actually, the World Bank has already readjusted its forecast for the performance of this year for the global growth rate from 5.5 to 4.1, and that's the most recent one. So China is part of the world economy and also a strong part of the world economy, and so definitely we're going to impact it. There are several elements that are hanging over the Chinese economy as a sort of pressure. One is, of course, the spike in the energy prices. And then, of course, the Chinese way of COVID-0 approach to this. One is a temporary impact, I should say, negative impact. But, well, the hope is that, okay, we're going to pay the pain at the moment, and people can have better confidence, not only the Chinese people, but the world business community with China, because we did quite successfully and remarkably successful over the last 2 years for zero COVID policy. So why don't we have another try? And of course, then the Ukraine conflict is having a lot of impact, and because China, first of all, has a lot of business connections with our neighbors, either in Ukraine or Russia and the rest of the neighboring countries. And so now the supply chain is also being disrupted, and of course some companies are fearing of a secondary type of sanction over China, so therefore there is quite a level of forbearance in their business dealings. So overall, I think the first quarter is doing pretty good. Hopefully, we're going to have a V-sign, and so next quarter definitely we are going to have some fallout that's being felt by the economic figures. By the second and third quarter, we may, but the third and fourth quarter, we may have a climb over the hills.
Over the hills. Picking up what Miguel has said about Shanghai, Shanghai is such an important place, for China and for the world, obviously. But people are looking forward to the end of those restrictions. So hopefully, there's a prediction, I think, from one university that it will end basically at the end of this month or next week, I would say.
Yeah, so, any major decision will have to weigh on the cost and benefit, but China seems to be people centrality, so that's something that really deserves quite a sort of respect all over the world. So that's our ideological approach, because we have too many elderly people, and now Shanghai is the most populous city in China, so if this goes out of the control, and the economic consequence, social consequence, and even political consequence can be large. So therefore, there is a sort of a legitimacy to do that. But of course, at the grass level, the underground enforcers and managers, they need to do a far better job than what they have shown.
Well, Charles, obviously, China pays so much attention to basically saving lives. Do whatever we can to stop or to prevent the spread of the virus. Of course, the situation is changing. And now with Shanghai, as Miguel has said, hopefully other parts of the country could learn a lesson and do a better job. On one hand, you continue to control and prevent the spread of the virus. On the other hand, to develop the economy.
Yes, absolutely. My concern actually is not quite on the virus side. My concern is what happens if the war continues. European economy starts to have problems, because I was speaking to the CEO of a major German company who told me that they have contingency plans. If they don't get enough natural gas, electricity, they may have to lay off about 40% of its people. Now, what happens to downstream from them? Then you're looking at serious economic downturn in the engine of Europe, namely Germany. And if the same thing happens with France and Italy, there could be a very serious economic downturn. And being EU countries being major trading partners of China, that could affect not only export imports from China, but also the supply chain overall. There's no question that there will be impact on the supply chain, and there could be significant hit on one of China's major engines of growth, and that is its import-export business. We don't know what's going to happen in the next month or two, but given what's happening in Europe now, it's not to be optimistic that natural gas will flow, coal will flow, oil will flow. The increase in cost of these energy, as well as a lot of the raw materials, including food prices, in Europe is already having a serious impact. And that could lead to a major economic downturn for all of Europe.
Mm-hmm.
I think let me add, well,
Go
there's
ahead.
also another factor that needs to be taken into consideration, which is a fundamental change of the Chinese growth structure. Because we used to have the two major locomotives for Chinese economic growth, real estate development, now that's flattened out, and the automotive industry. And so right now, another pain we need to really to take is really if we really go for innovation growth and high quality growth, and that's something that we have to allow certain space of deceleration of economic figures in order to gain a upward trend in this industrial quality and consumption quality. So and also another figure is that the consumption is really now taking almost 70% of the whole economy, which also shows that we are shifting from merely economic figures of living standard now into life quality. So that's something rather positive if you look at over long term.
Mm-hmm. Miguel, two questions for you. Obviously, there's, as Charles said, there's probably spillover effects from the war, which is likely to continue for some time in the future. And also from the sanctions from Western countries imposing on Russia. And you do see like the rising prices, the fuel prices, and also food prices, not only mostly in developing countries, but also we do see the outcomes even in developed world like European countries, right?
No, the problem that we have in Europe is that we rely on Russia for energy, and especially gas. That's why we do debate whether we should impose sanctions on imports of gas or not. And I hope that we don't, because gas is, relatively speaking, more important for the buyers, for the European countries, than for the sellers, Russia. I give you the figures out of my mind. Russia gas exports total is about 55 billion, and those that are sold to the EU is about 40 billion, 40, which is about 2% of total Russia GDP. So that's kind of the value at risk for Russia. It's not a large number, but for us, we import about 40% of the total gas supply from Russia. So if we were to cut off that supply, we would have an immediate drop in gas of about 40%. And like we heard before, many companies, especially in Germany, Italy, and almost all of the Eastern European countries would have serious difficulties. I predict a minus 7% drop in GDP in Italy if tomorrow we were to cut off Russian gas supply without having the alternative, because the alternative do take time. We cannot immediately buy from other countries. So that's a big worry. But I'm not worried about this too much for China, because there is almost an inverted demand elasticity for Chinese goods that tend to be deflationary. So when Europe has economic troubles that we may likely have, there could actually be more demand for, let's say, the cheap basic goods that China exports to Europe. So I'm not too worried about China's export, which I think actually they may be quite resilient and even getting stronger if Europe has problems. But I think it's also an opportunity for China to step in and play an active role, for example, in the African countries, because they would suffer a lot for the lack of cereals, wheat and corn from Ukraine and Russia. We have Egypt relying heavily on those two countries. So this is where China could, in a way, take advantage of the situation. And I think Europe should help China to be playing a good role in Africa, because we don't want Africa to have a social problems which would cause not just economic downturn, but also migration into Europe. So the whole thing is connected, and I think China is relatively isolated. Now, if I may, just one point back to the GDP figures, because we have a GDP of 4.8, but within that, I think it's important to notice that the personal income, which is what people feel, people don't feel GDP, they feel personal income. For the urban area grew by 4.2% in real terms, so a little bit less than the GDP. But for the rural, grew by 6.3%. So the average, let's say, rural citizen experienced his personal income grow by more than the GDP. So even if in the second quarter we were to have a weak GDP, there is a buffer of personal income that could in a way mitigate the effect on people. So in a way, despite a lower GDP growth, personal income could be stronger. And at the end of the day, this is what the government does, serves the people to make their life better. And this means also that the disparity, rural-urban, has decreased because rural has grown faster than urban. So it's all kind of part of a big system that may see people life affected, but not by as much as GDP figures could indicate.
Mm-hmm. Well, picking up on what Miguel said, Charles, a survey by the China Tourism Academy shows that more than 86% of urban and rural residents would like to travel in the next 3 months. That's a figure up 2.14% year on year. So that's pretty, confident. Right? People say as long as it's, less restriction, I will travel to some other parts of the country and to take a look.
I am one of them. Being locked up in Beijing for quite some time, I have trips planned for Shanghai, Shenzhen, Zhuhai, and cannot go to any of these places. I think what we're talking about is general consumption, not only tourism consumption. We'll see the V-shape, the real takeoff when the pandemic situation comes under control. You will see, for example, when Shanghai is settled down, there will be massive personal consumption because of pent-up demand that will come, not only on tourism. I can see all of that. This has been a pattern over the course of the last 2 years. When a city is locked down or an area is locked down, immediately thereafter, consumption goes up by bounds, by leaps and bounds. And this will be very positive for the second half of the year if the pandemic comes under control.
Mm-hmm. Well, that's a if. We will see, of course. That's why we see this year is full of uncertainty. Part of the problem, you see there are visible challenges, there are invisible potential challenges, Bocheng. But what we can do, we have cut this reserve ratio rate, by 25 basis point, and then we say a large amount of tax reforms and tax reduction are expected to give about 2.5 trillion yuan this year to ease the burden of businesses and show up the vitality of the market entities. What kind of a role do you expect it to play?
Well, overall, we continue to maintain a business-friendly environment. That's the key, and also let the market run. And the fact that China published the new guideline on unifying the national market is now being interpreted with mixed signals, whether we are going to streamline the market rules or whether we are going to take further control over the economy by the state. So that's something that needs to be seen. So anyhow, the effort is there to reduce the cost of doing business and to manage the COVID or any other challenges in a more scientific way. And that's something very important. The other is that there is also a split of income between business versus government, between central government and local government. And now the release of some of the tax burdens onto those businesses by tax refunds. And this is something very positive, and is also a plan to target 90% to those small and medium-sized businesses. So that's something, a very good news to shore up the business confidence, because those small businesses, they are the part of the industrial cluster that is there to fertilize the market. So individually they are small, but they collectively can be a very strong force for the continued growth and the resilience of the Chinese economy. And then I think, normally in difficult times, the best way, as I am as the educator for my life, to strengthen capacity building, to either for vocational skills training, and also to have more people to receive the career track type of education. And this is something that we are really investing into the far future.
Well, Charles, of course, you would like to see more liquidity from the central bank, from the government, so as to shore up this market. But then there's, how much we can do, how far we can go. Because if you look at developed world, like the US, they are planning to raise interest rates. And then if we cut interest rates too much, and then there's a worry or concern that the capital may, say, run out of this market. And that's something you don't want to see, right, for the Chinese economic recovery here.
Absolutely. As a businessman, as the professor said, businessmen need to restore their confidence as a businessman and an investor. I have some queries on what the government can do. Cutting reserve ratio by 25 basis points leaves a lot of room still, because the reserve ratio right now is still about 8%, or 800 basis points. So 25 basis point, I think, is really below market expectation. I think the market was expecting quite a bit more. But in terms of the exchange rate or the interest rate in the US and the quick tightening of the US monetary policy, I don't think the impact on China will be significant. The impact on the Japanese yen has been very significant, and on the euro and the pound too. But the RMB has stayed pretty strong, which shows that there hasn't been an outflow of capital on a grand scale. I think there's several reasons for it, because as an investor, we still have quite a bit of confidence on the Chinese economy going forward, and in the medium and long term. I must say, less confidence in the US economy, given the fact that they printed so much money and the inflation rate is now reached well over 8%. I think by next month it'll probably be over 9%. At this rate, the US can enter a phase of stagflation, which will be quite serious in terms of potential returns on investment. So as any major investing institution or entity would tell you, we have a portfolio management system that we look at what returns will, which region or which country will give you. And it's still quite positive on the Chinese side. So I don't think the interest rate changes will make a big impact, as the RMB strength has demonstrated.
Well, of course, China is part of the global economy, and it will be impacted by the global economic performance. If you look at the IMF, they earlier warned that the global inflationary shock caused by the Russia-Ukraine conflict and the ongoing COVID pandemic will lead to lower economic growth this year and next. The IMF cut its forecast for 143 countries around the world representing 86% of the global GDP. So, Michaela, is this a potential crisis for the global economy?
I don't think so, because the IMF or the World Bank, this kind of global GDP forecast, if I may say, they kind of over time are losing their meaning, because it's an average of extremes. We have, like in the COVID case, we had European economies going down 6, 7, 8, 9%, and China, Korea, and others even going up 2.3 in the case of China, and then the average was X. So it was interesting when the world was moving all in the same direction. But now we are witnessing a decoupling, not just of trade, or not even a philosophical decoupling. We're seeing a decoupling of performance. So it's a typical case where your body is 100 degrees on the head and 0 degrees on your feet. The average is 50, but it's not comfortable at all. So I do take a little bit with a pinch of salt to these global averages, and that's what we are doing in our team. We kind of not ignore them, but we really go by blocks. Because if we have China growing at 5 and Europe -1, it's clearly very different than having both the system growing at 2%. And so I would, my recommendation to investors also to look at the regional growth rates, and then of course interact those via trade. And I agree also on the monetary policy of the United States. It's never going to have a big impact on the Chinese renminbi, because the capital account in China is not fully open. So the Chinese government can manage the value of the renminbi, and the money that outflows of China is mostly, let's say, financial money that looks at the spread between interest rates. But the real economy investors, they do want real returns in the real economy. And with inflation in the US going up, that's a worry. So I think the good money stays in China. Is the money that we don't want very much that could go out, and that may also be a welcome departure, because it's a kind of hot money.
For the real economy and for the long-term growth. So, Baocheng, briefly, of course, the target is 5.5% for the year 2022. Do we have enough tools to achieve that goal?
I think we have a lot more tools. And number one is that China still maintains a very high interest rate as compared with all the major developed economies. So we have far larger room, as Charles indicated, to deal with not only with the capital reserve ratio, but also deal with the interest rate. But right now, liquidity is not really a major problem. It's really the business confidence that needs to be shored up, and where the PMI can really move above the contraction rate. Then, okay, employment, we had 5.8, but hopefully it's going to be reduced to, below 5% unemployment rate. So this is something that we need to address.
Well, with that, we come to the end of today's show. Many thanks to our guests, Professor Liu Baocheng, Michaela Giracci, former senior economic official from Italy, and Charles Liu from Hall Capital. You can also find us on the CGTN app on YouTube. Thank you for being with us. I'm Xu Qinduo. See you next time.